Most families don't fall apart because someone passed away. They fall apart because no one planned for it, and it leaves a massive mess in the hands of the people they love most. After 15 years in this industry, I have seen it all, and I want to help you prevent that from happening to your family. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist and the owner of Diamond Point Financial. Each week on Pointe Perspective, we help you make sense of the markets, the economy, and your financial life from a professional perspective so you can make financial decisions with more clarity and confidence. This week, we're focusing on expectations, interpretation, and long-term planning. First, we'll break down what earnings season means, why markets react so strongly to corporate reports, and what this recent quarter may be telling us about the broader economy. Second, we'll review April's economic data, discuss inflation, labor market resilience, and how the current environment compares to previous economic cycles we've seen throughout history. And third, as we begin our June strategic planning focus, we'll introduce estate planning, what it is, why it matters, and why it's often much more connected to your overall financial plan than people may realize. Whether we're evaluating markets, economic trends, or your family's future, strategic planning starts with understanding the structure that's holding it all together. Now that first quarter earnings season is wrapping up, this is a good time to step back and explain what earnings season really is and why the markets pay so much attention to it. Throughout the quarter, you'll constantly hear headlines like company beats earnings, revenue misses expectations, or guidance lowered, but many investors don't fully understand what's actually being reported or why the market reacts so strongly to it. Earnings season refers to the period when publicly traded companies release their financial results for the previous quarter. These reports typically include information about their revenue, profits, expenses, cash flow, and forward guidance about what management expects going forward. And because public companies are such a large part of the economy, these reports can provide insight into consumer spending, business conditions, corporate confidence, and overall economic momentum. Earnings season happens 4 times a year following the end of each fiscal quarter. One of the most closely watched metrics is earnings per share, often referred to as EPS. That measures how much profit a company generates relative to its outstanding shares, and markets compare those results against analyst expectations. But interestingly enough, over time, we've almost created this environment where simply meeting expectations is no longer enough. In many cases, companies are expected to exceed expectations in order for markets to react positively. And if guidance disappoints or growth slows even slightly below expectations, markets can react very aggressively. In previous weeks, we've discussed the effects of emotional trading and short-term market behavior. Between algorithmic trading, rapid information flow, and both seasoned and newer investors reacting almost instantly to headlines, earnings season can sometimes create significantly more short-term volatility than investors were historically accustomed to seeing. Another topic you may have heard discussed recently is the idea of allowing companies to move toward optional semi-annual reporting instead of quarterly reporting. Under the proposal, companies could elect to report every 6 months rather than every quarter. Some people support this idea while others disagree, and both sides have reasonable arguments. Supporters argue that quarterly reporting can pressure companies to focus too heavily on short-term expectations instead of long-term strategy. Opponents argue that less frequent reporting could reduce transparency for investors. The SEC is currently collecting public feedback on the proposal through July 6th, and if approved, it could still take 6 to 12 months before the rule would realistically take effect. So the earliest companies could potentially begin choosing semi-annual reporting would likely be sometime in early 2027. Now, looking specifically at this recent earnings season, results generally came in better than many investors expected. Large cap technology companies continued showing strong earnings and significant spending related to artificial intelligence infrastructure and development. Margins in many areas held up, consumer spending remained relatively stable, and corporate guidance, while cautious in some sectors, was not nearly as negative as many investors anticipated earlier this year. One thing that didn't change this quarter is that we continue seeing differences across sectors. Some companies tied closely to artificial intelligence and infrastructure spending remained strong, while other areas of the market experienced slower growth or more pressure from higher interest rates and cautious consumer behavior. At the end of the day, earnings season is about evaluating expectations versus reality. Markets don't just react to whether data is good or bad. They react to whether it's better or worse than expected, and then analysts and investors evaluate the factors contributing to those differences. And while growth has certainly slowed in some areas, the overall picture from this quarter remained more stable than many investors anticipated. Now, that doesn't eliminate future risks or volatility, but it does help investors track trends, evaluate changes within the economy, and better understand how businesses are responding to the current environment. Over the last several months, we've been discussing how economic data influences expectations throughout the markets and the broader economy. And as April's economic reports have largely been released, this is a good opportunity to step back and look at what the data showed. One of the biggest areas investors were watching closely was inflation. Since 2022, inflation has remained one of the Federal Reserve's primary concerns, and markets have been highly sensitive to any signs that inflation pressures may be reaccelerating. In April, inflation data generally came in cooler than many investors had feared. But we have to put this in context because if you compare it solely to the last few months, you'd think I was crazy for even saying that. Inflation did increase to 3.8% in April, which is up from 3.3% in March, and it remains meaningfully higher than levels we saw earlier in the year. So when I say it's better than we had feared, I'm referring to the numbers with perspective to what's happening in our current global environment, particularly the conflict in Iran and oil prices, which affects almost everything in our daily lives. That doesn't mean inflation has disappeared, and it certainly doesn't mean prices are suddenly returning to where they were several years ago. But seeing only a modest increase still suggests that inflation pressures may continue moderating gradually rather than moving aggressively back upward. We also continued seeing resilience within the labor market. Employment data remained relatively stable overall, and while hiring has slowed from the elevated levels we saw coming out of the pandemic, we're still not seeing the type of widespread deterioration that many investors were concerned about earlier in the year. Employment and consumer spending tend to move closely together throughout the economy, and while spending has certainly become more selective in some areas, consumers overall have remained more resilient than many analysts initially expected. We've spent time previously discussing economic cycles, but as a reminder, economies don't move in straight lines, and certainly not for long periods of time. Periods of rapid growth are often followed by periods of slowing, stabilization, or contraction as the system adjusts to higher interest rates, tighter liquidity, and changing consumer behavior. And historically, we have seen environments somewhat similar to this before. In the mid-90s, for example, the Federal Reserve also worked to slow inflation and moderate growth with what we now call a soft landing. And even during periods like the early 80s, while the economic pressure was much more extreme, the broader goal was still the same: slow inflation while eventually restoring long-term economic stability. Now, every cycle is different, and the economy never repeats itself perfectly. In this current cycle, we can clearly see that growth has slowed in certain areas. Higher interest rates are clearly creating pressure in some areas, and consumers have become more cautious. But overall, the economy has continued showing more stability and resilience than many initially expected. Of course, that doesn't mean risks have disappeared. We're still closely watching inflation, interest rates, consumer debt, commercial real estate, global tensions, and broader economic growth. Economic data can change quickly, but from an expectations standpoint, one of the most important takeaways from April was that many of the surprises were not negative surprises. In environments where investors are already positioned cautiously, that can become meaningful for both market sentiment and volatility. At the end of the day, economic data is less about predicting the future perfectly and more about tracking trends as they develop. As we move into June, we're shifting our strategic planning focus toward estate planning. This is probably one of the most misunderstood areas of financial planning. When many people hear estate planning, they immediately assume that it only applies to the ultra-wealthy families or people with large estates. But estate planning is much broader than that. Estate planning is really about organization, structure, control, and making sure your wishes are clearly documented and carried out appropriately over time. Estate planning can include things like wills, trusts, powers of attorney, healthcare directives, beneficiary designations, and strategies surrounding how assets transfer between generations. It's about reducing confusion, protecting family members, maintaining privacy in some situations, and helping to create smoother transitions during difficult times, which can also help maintain relationships within a family. Unfortunately, one of the biggest mistakes people make is assuming that they have more time to put these documents in place than they actually do. One particularly large piece of estate planning that gets overlooked is taxes. Even modest estates can create tax complications depending on how assets are structured and transferred to beneficiaries. Depending on how assets are titled, transferred, or inherited, estate planning may help preserve more wealth over time. You may hear discussions surrounding step-up in cost basis, trust structures, beneficiary planning, charitable strategies, or estate tax exemptions. And while not every family will need advanced structures, almost everyone benefits from having some level of organization and documentation in place. This is also where estate planning becomes much more connected to your overall financial plan than many people realize. If you want the most positive outcomes, your investment accounts, retirement accounts, insurance policies, business interests, real estate, and beneficiary structures all need to work together cohesively. When they don't, it can create unnecessary complications later for the people that you care about most. And unfortunately, those complications often happen during moments when families are already emotionally overwhelmed. Getting started is easier than you might think. Before we get further into June, I want you to think about the people that are important to you and list them out. This can include your kids, grandkids, parents, siblings, nieces, nephews, or even that sweet friend you've had for 30 years. Anyone that you know you want to include in your legacy. Then make a list of all your assets, your accounts, life insurance, real estate, and important personal property. Start aligning the person with the asset. And while you're at it, begin thinking about who you'd want handling your affairs if something happened unexpectedly. Keep in mind this is just a rough draft. It isn't legally binding, but we will handle those next steps in the coming weeks. If you're married, I like to suggest that you both make your own lists and then compare and adjust it if needed. And remember, this doesn't need to be a somber affair. Your legacy is something that should be celebrated and embraced. At Diamond Point Financial, this has become an increasingly important part of the planning process for many of our clients. We work closely with our clients, offering estate planning resources designed to help clients implement planning strategies more efficiently as an integral part of their broader financial plan, not in addition to it. Comprehensive financial planning isn't just about building wealth. It's about leaving your legacy in the best possible way. Today, we broke down what earnings season is, what April's economic data may be telling us about the current cycle, and why estate planning is often much more connected to your financial life than people realize. If this helped bring some clarity to what you're seeing in the markets, in the economy, or in your own financial plan, make sure you subscribe to our channel for new discussions every Thursday. If you'd like a more concise breakdown, you can subscribe to our weekly newsletter every Friday. And if you have questions about your own financial situation, you can learn more about Diamond Point Financial using the link below. I hope this offered some useful perspective. Until next week, take care.